Adjustments to income in Canada. Understanding above-the-line deductions. When calculating taxable income in Canada, several adjustments can be made to an individual's gross income. These adjustments, often referred to as above-the-line deductions, are crucial as they reduce the overall taxable income, thereby potentially lowering the amount of taxes owed. Let's explore some common adjustments and provide detailed explanations and examples to make these concepts clearer. 1. Student loan interest deduction. This adjustment allows individuals to deduct the interest paid on qualifying student loans from their gross income. Example: suppose Sarah, a recent graduate, paid CAD $1,200 in interest on her student loans last year. She can subtract this amount from her gross income, reducing her taxable income by CAD $1,200. This deduction is particularly beneficial for recent graduates who may still be in the early stages of their careers and not yet earning a high income. 2. Retirement contributions. In Canada, contributions made to certain retirement savings plans, such as the Registered Retirement Savings Plan, RRSP, can be deducted from gross income. This deduction not only reduces taxable income, but also encourages individuals to save for retirement. Example: imagine John earns CAD $70,000 annually and contributes CAD $5,000 to his RRSP. The CAD $5,000 contribution can be deducted from his gross income, effectively reducing his taxable income to CAD $65,000. This not only provides immediate tax savings, but also helps John save for his future. 3. Health Savings Account, HSA contributions. Contributions to a health savings account, HSA, can be deducted from an individual's gross income, similar to retirement contributions. However, it's important to note that HSAs are more commonly used in the United States. In Canada, a similar benefit is available through contributions to a health spending account, HSA, or a private health services plan, PHSP, for self-employed individuals or employees in certain circumstances. Example: consider Jane, who is self-employed and contributes CAD $1,000 to her HSA. This contribution can be deducted from her gross income, reducing her taxable income by CAD $1,000. This deduction helps Jane manage her healthcare expenses while also providing tax savings. 4. Educator expenses. Teachers and educators can deduct certain out-of-pocket expenses incurred for classroom supplies. This deduction is aimed at supporting educators who often spend their own money to enhance the learning experience for their students. Example: Miss Lee, a high school teacher, spent CAD $300 on art supplies and educational materials for her classroom. She can deduct these expenses from her gross income, reducing her taxable income by CAD $300. This deduction acknowledges the personal investment that educators often make in their students' education. Tax deductions in Canada, a detailed overview. Tax deductions are crucial in reducing the amount of income that is subject to taxation, thereby lowering the overall tax liability. In Canada, deductions come in two primary forms: standard deductions and itemized deductions. Let's explore each type in detail, with explanations and examples to help clarify these concepts. 1. Standard deduction. The standard deduction is a fixed amount set by the government that taxpayers can deduct from their gross income. This deduction is straightforward and does not require taxpayers to itemize their specific expenses. It serves as a baseline deduction that reduces taxable income. Example: in Canada, there isn't a traditional standard deduction as seen in some other countries, like the United States. However, there are basic personal amounts and other non-refundable tax credits that function similarly by reducing taxable income. For instance, the basic personal amount for the 2023 tax year is $15,000. This means every taxpayer can deduct $15,000 from their income, reducing their taxable income by that amount. 2. Itemized deductions. Itemized deductions allow taxpayers to deduct specific expenses from their gross income. These deductions are particularly beneficial when the total of itemized expenses exceeds the standard deduction or basic personal amount in Canada. Here are some common itemized deductions. A. Medical expenses. Taxpayers can deduct medical expenses that exceed a certain percentage of their adjusted gross income, AGI. This percentage threshold is set by the government and varies. Example? Suppose Anna has an AGI of $50,000 and incurs $5,000 in eligible medical expenses. If the threshold for medical expense deductions is 3% of AGI, Anna can deduct expenses exceeding $1,500, 3% of $50,000. Therefore, she can deduct $3,500, $5,000 minus $1,500 from her taxable income. B. State and local taxes. In Canada, taxpayers can deduct certain provincial or territorial income taxes paid, although this is more commonly addressed through tax credits rather than deductions. For example, charitable donations often come with tax credits rather than deductions. However, deductions related to property taxes on investment properties or business-related expenses can apply. Example: John owns an investment property and pays $2,000 in property taxes. If eligible, he can deduct this amount from his gross income, reducing his taxable income by $2,000. C. Mortgage interest. Interest paid on mortgages for properties that are used to generate income, such as rental properties, can be deducted from gross income. However, interest on personal residences is generally not deductible in Canada. Example: Emily has a rental property and pays $8,000 in mortgage interest annually. She can deduct this interest from her rental income, reducing her taxable income accordingly. D. Charitable contributions. Donations to qualifying charitable organizations can be deducted, providing a tax benefit while encouraging charitable giving. Example: if Max donates $1,000 to a registered charity, he can claim a charitable donation tax credit, which reduces his overall tax liability. The actual amount of the credit varies based on the amount donated and provincial regulations. E. Casualty and theft losses. Deductions for casualty and theft losses are limited and often require the losses to exceed a certain threshold. Example: if Sarah suffers a loss of $10,000 due to a natural disaster and the applicable threshold is $1,000, she may be able to deduct $9,000, $10,000 minus $1,000 from her taxable income. Understanding the impact. Deductions are an essential aspect of tax planning. They help reduce the taxable income, which can lower the overall tax burden. For new taxpayers or students, understanding these deductions can aid in financial planning, ensuring that they take advantage of all available tax benefits. As tax laws can be complex and subject to change, consulting with a tax professional or referring to the Canada Revenue Agency, CRA, for current regulations is recommended.